Hi friends, welcome to this lecture. So grab your notebook and your pen and let's get started. So when to trade. Timing in trading, timing in trading is a topic that is very important because uh, the fact that the market is open 24 hours a day doesn't mean we trade 24 hours a day. There are times during the day that we try to focus on the markets. There are times when we try to avoid the market, and this is because trading activity, the bulk of trading activity happens when real life human beings are active. You understand? So it is based on the transactions of human beings, and the times that humans are active really affects the markets a lot in different locations now because trading activities are happening all over the world every time. And you can imagine the time when it's active in Sydney is not the time when it's active in New York. So timing is one of the most critical yet overlooked aspects of trading. So knowing when to trade can often be just as important as knowing what you trade or how to trade. So what you trade and how to trade is two different topics, and when to trade is also completely different. So the market moves in rhythms, it moves in sessions, it moves in volatility cycles, and moves in liquidity windows. And successful traders learn to align their activity with those rhythms rather than fighting them. The Forex market is open 24 hours a day, Monday to Friday during weekdays. The cryptocurrency market is open every single day. Stock markets are open specific time depending on the country of exchange. The New York Stock Exchange, for instance, is open 2:30 p.m. 2:30 9:30 a.m. 9:30 a.m. EST, that's Eastern Standard Time. Um, in Nigeria, that's 2:30 or 1:30, depending on daylight savings. So the all markets don't trade at the same time all the time. So this is something you have to keep in mind going forward. The first market is open 24 hours every day, Monday to Friday. That's during weekdays. However, the bulk of trading activities does not happen 24 hours every day. There are specific pockets of time during the day when there is relevant trading opportunities. So I'm emphasizing on these things because these are very important things. This is something that you're listening to in your very first video of being introduced to Forex, and I'm hammering on it because it's important. It's important. It's important to know that there are specific pockets during the day that you should be trading. It's not every time during the day that you should be trading. Are there analyses? Are there styles of trading? Are there strategies that might employ you or allow you to trade every time during the day? Yes, but when you finally lay your hands on such strategy or such technique to trade, and that is what you're using, you would know that that's why you're doing it. It's because this is what I am using. However, the misconception is that you can trade anytime. You can trade anytime during the day, during the 24-hour window, during of the weekend. There are specific periods where it's relevant trading activity happens. Again, I'm hammering on this because it's important. So the Forex market operates 24 hours a day during weekdays, but it's divided into trading sessions based on the world's financial centers. So we have four major financial centers. We have Sydney, we have the Tokyo, London, and we have the American. So Sydney is the Australian session. The Tokyo is also the Asian session. The London also the European session, which means it embodies the session of Germany, France, Spain. So economies in Europe that are relevant as well. And then the New York session, which is the American session, which is the most important and which is the most relevant. So uh, some characteristics about this session that you should keep in mind is the Sydney session usually moves with low liquidity, slower moves, and it is good for Sydney traders. It's good for people who live in this region, and for peers that trade in that session, which are one the New Zealand dollar, the Australian dollar, and sometimes the Japanese yen. So the time that this occurs using GMT now or UTC is between 10 p.m. to 7 a.m. The Tokyo session, it does have some relevant liquidity. However, it is most apparent on the JPY pair, and maybe someday we'll be trading the Chinese yuan. So yes, currencies like that, the Chinese yuan, the JPY, the Malaysian ringgit, these are currencies that will move re reasonably during this session. The London session is high in volatility and high in trading volume. The American session is high in volatility and USD pairs dominate. Now, I'm going to explain why this happens to you. See, we live in a world that is controlled by world powers, and the reality is that America today is, well, technically one of the most powerful countries in the world. The US dollar is pretty much the only currency that, no matter where you're from, you've heard of that currency before. There are currencies, I don't know what currency they spend in, I don't know, Papua New Guinea, for example, or Samoa or something. There are whole countries in this world that we don't even have an idea of what currencies they spend. That's because it's not relevant for world and international trade, or the country itself is not a dominant player in international affairs. So that being said, the United States of America is the country. It is technically a world power. I mean, we can argue that there are other world powers, but it is a world power. It may not be the world power, but it is a world power. So, and its currency certainly has to be of value. So, because of this, something that usually occurs is that when the US traders are trading, it's very relevant because they control large companies in the world, Amazon, the Microsoft, the Tesla, Facebook, they have the money and they are technically the movers of currencies, because even the liquidity in other sessions would happen based on the activity of American traders. I hope what I'm trying to drive is getting to you because it's very important for you to understand the role that the American system plays in international affairs. That may be changing now, but it certainly has played a massive role over the years. So that's why the New York session is pretty much the most volatile session, the most liquid, the most exciting to trade. Next, which is the London session or the European session. And this you can understand why. So the block of countries in Europe are also very relevant, and they have a lot of companies there that are involved in the affairs of the world. So yes, that's why they're relevant as well. So the best trading session occurs during London and New York, which is why I went on such description, with occasional volatility during the Asian session. So volatility in trading. Volatility is what creates opportunity in trading, but too much of it can destroy consistency. Yes. Too much of it is when the market just keeps flying in one direction, without without allowing participants to engage, and sometimes it just becomes too much whereby a trader doesn't know what to do, how to enter. Your risk parameters are not working, your ideas are not playing out, so it shouldn't also be too much. It gets too much sometimes. For instance, when I think this is behind us now, so when Trump tweeted some tariff thing with China, and then the crypto market crashed, the stock market crashed like in very short periods of time. Um, so the this is what volatility is. Volatility is speed. So basically, if you're going to travel a distance so ordinarily to travel this distance from point A to point B should take you maybe 10 hours, but then you were able to put the rocket booster on your car, and then you shorten the distance from 10 hours to 2 hours, right? So you did shorten the distance, but you also increase the risk of danger, the risk of a crash, the risk of fatality. So, volatility has its advantages. You sure will get there quickly, but you sure can face massive, massive fatal damages. So that's what volatility is in trading, the speed at which the price moves. So when the market is quiet, trades often stall. When it's too wild, uh, stop losses stop losses get hit easily. So stop losses are the breaks that you put in the market to prevent yourself from losing more than anticipated. It will be further explained later. I do trading times when volatility is moderate to high with structure and direction, not chaos. So that's typically after an economic announcement. Typically after an economic announcement, not before. because before there is uncertainty and there is already uncertainty in the market. So we don't want to be trading when there's hyper uncertainty. So that's typically after when the economic announcement has been made. There's news, CPI, Consumer Price Index, PPI, FOMC, rate release, GDP announcement. So all of these things would be clear. So when these things are coming out, traders are often advised to take stay behind and just watch. So after the news release has occurred, it could be the next 5 minutes after, it could be the next day or the next week, doesn't matter. But basically, after the news has occurred and the market has settled into the reality of the announcements, then these conditions are met. So when price breaks out of consolidation zones and active trading sessions, which are the trading times, that's what described in the previous slide. So economic calendar, this is a tool that lists scheduled economic events, reports, and data releases that can influence financial markets. So I would ask you all to go check out forexfactory.com. There's a couple other of them. There's FX Street. There is Baby Pips. You can use Baby Pips to check the economic calendar. And there is my FX book. There's so many of them, really. Econo Day. But just go to forexfactory.com. It's pretty much the gold standard of economic calendars. It is the most accepted. The platform is clean and it gives you an idea of what you're looking at. So at first, I don't expect you to understand what you're looking at, but yeah. So that's what an economic calendar is. It gives you a list of economic releases. So economic releases are important information that a country releases about its economic activities. So GDP is one of them, CPI is one of them, inflation rates, which is also CPI, is two inflation rates, which is PPI and CPI. Rates, interest rates release, which is FOMC in the US. So these details are what a country uses to gauge its economic conditions, economic health, and they are released publicly. Everybody sees them, everybody knows them for every country in Nigeria. It's there. Currently, our inflation rates is down, I think 16% or something. So this is what an economic calendar displays. So trading without checking the economic calendar is like sailing without checking the weather. Again, I'm going to say this is pretty much your first set of videos you're watching, your first set of introduction to the absolute newbie. This is pretty much your first set of introduction to trading. And you already know that trading without an economic calendar is a disaster. I didn't know this until I was like a year into trading. And that's the truth. I didn't even understand what an economic calendar was. I wasn't taught, I wasn't shown. So this is very relevant information. This is like straight to it. Trading without an economic calendar is a disaster. You have to understand what is happening in the currency you're trading. At least you should know, okay, look, I'm expecting some volatilities. Anything can happen at this period. I don't know. And you can prepare for that. So high impact news such as interest rate release, inflation data, or job reports can cause sharp, unpredictable moves. Yes, now it could be sporadic, such that even if the market is going to go a certain direction, it first goes down then up. Like it could just be wild. I'm not trying to put fear into you because people do trade economic events, and some people trade it profitably. I don't know how consistent that is, but yes, some people can trade it profitably. To be the job of the trader to study and backtest and practice before you can decide whether you would trade such. But it's generally advised as a beginner to just stay away and observe what happens after. So smart traders do one of two things: avoid trading right before high impact news to protect their capital, or prepare to trade the aftermath to catch the directional moves once volatility settles. I think this brings us to a good landing. I did go on a very long descriptive, narration of what is happening, and this is deliberately because I just want to explain it how I feel about it, not just how I know it, how I feel it. And I think this is very important. So I will bring this to landing now, and if you have any questions, please shoot them to me. I'll be more than willing to answer your questions. And yes, until the next video, I wish you peace and good luck.